ready? You got me running, you got me running, got me running. Shake it, shake it, shake it, baby. Raise your hands up, raise them up.
Hello, everyone, and good morning, good afternoon, or good evening, depending on where you're watching this, and happy Friday. We are doing a breakdown on the inflation data that did come out last night for us with GMT 8 time zone, and Kim Hong will be focused on that. I hope if you did trade around the event or a little bit after, hopefully a little bit after, not right on it, I hope that it was a good trading session for you. There was quite a bit of activity in the EcoFin LCMS Traders Club chat as well, so that was great to see. And if you are looking to get involved in that chat as well and really take your trading to the next level, make sure you visit the Jindal Thai website. We are taking on new members as well, and we do have the USD CAD in focus. We've got oil, I've got the cryptocurrencies, and also the US dollar index. But before we get into more detail for today, I will just discuss the risk disclaimer as well. So I'll just bring this up and read it out. Any information shared in this video is not intended to be a trade recommendation. It is solely the opinion and views of the speakers. So please remember to do your own analysis prior to entering into any trades. Feel free to ask questions during the call as well. We're happy to help. And again, if you are a member, feel free to reach out to us in the chat as well. But just to kick us off, we did have that significant inflation print from the US last night. And Kim Hong here is just going to run us through the details of what that means as well for the US dollar and anything in regards to trading opportunities as well. So over to you now, Kimmy.
Okay, welcome to today's daily currency call. It's Friday, so happy Friday. Okay, so yesterday we actually see quite a bit of movements, okay, a big move I would say from the in the currency market, okay, mainly due to the stronger than expected US CPI data release. Okay, so let's look at the figures. Headline inflation. Okay, right now I would just focus on the annual data, okay, annual inflation data, because that's something that's pretty much what everyone is looking at right now, okay, to see if there's a new record being broken and things like that. All right, so where is it? Headline inflation, okay, on an annual basis rose by 7.5%, okay. And the market was expecting a 7.3, okay, but like what we have mentioned yesterday, if it actually exceed the expectation, okay, then we are likely going to see a pretty big move in the US dollar, okay, and as expected, well, not as expected, but as shown here, we actually get a figure that is greater than the forecasted 7.3, okay, but as compared to the previous data release, okay, it was actually a 0.5% increase, okay, which is half a percentage point faster, than the previous pace of inflation. And then if we were to look at the core CPI data, okay, it was expected to be 5.9 and it actually rose by 6.0. All right. Once again, it's half a percentage point faster than the previous data release. Okay. So overall, we are seeing a very, very, very strong rise in inflation. Okay. And how strong is this, right? Previously, we were seeing something like close to a 40-year high, okay? Right now, we are still close to a 40-year high, okay? It's just that we are inching further and further to that level. Headline inflation, this is actually the highest reading since February 1982, okay? It's close to a 40-year high level. It's actually 1 month short of the 40-year high level, all right? And then for the core CPI data, okay, it's actually the highest reading since August 1982, just 6 months short of 40-year high, okay? So I think this, I would say is pretty much as good as a 4-decade high level already, all right? And because of this strong rise in inflation, okay, we are okay, what basically what this set of data does is that it actually supports, okay, it actually gives the Federal Reserve more confidence in terms of the recent hawkish move that's been carried out. All right, and that is likely the reason why we actually see a strengthening in the US dollar, okay, as opposed to some of you may actually think that a rise in a speed up in inflation may actually cause a weakening in the currency. Okay, so for Traders Club members out here, okay, we actually did a pretty thorough discussion on how inflation data can actually lead to the weakening or the strengthening in the currency itself, okay, yesterday. So if you guys want to have want to learn more about it, just refer back to yesterday's Thursday's evening Traders Club session call. All right, so yeah, because of this, because of the support on the Fed's hawkish move, okay, we actually see a stronger US dollar. All right, because as we all know, the Fed is trying to move faster, okay, towards monetary policy tightening, aka in this case, interest rate hike. All right, and this week we actually have been hearing, okay, and I pretty much will expect more members of the FOMC coming out to talk, okay, next week or so, all right? But this week so far, we have been hearing a lot of, I would say, pretty hawkish tone from the individual FOMC members, okay, except Powell, okay, because he don't really speak that often, okay? So, for example, right, just before the days, maybe like 1 or 2 days before the CPI data release, we heard from Master that she supports a rate hike in March, okay, and of course a faster path of hikes, okay, and then from Delhi, she supports a rate hike in March as well, and then from Bostic, he is actually leaning towards a fourth rate hike in 2022. So previously, when the economic projection materials was released by the FOMC, okay, Bostic actually voted for 3 rate hikes, but then right now he's leaning towards a 4th one this year, okay? And then after the release of the CPI data, shortly after, okay, we heard from Barkin that he believed it is past time to begin policy normalization. Okay, so basically, we should already get started. Okay, the central bank should already get started on policy normalization, which is, start to increase rate hike, start to, clear off QE, start to sell off, unload the bond holdings that the Federal Reserve has right now. Okay, and I believe this is the next one that I'm about to share is probably going to be the most hawkish one that we'll be sharing this week. Okay, and it's from James Bullard. All right. Now, James Bullard, he actually mentioned that he favors 100 basis points interest rate hike by 1st of July. So what this means is he's expecting interest rate to hike. He actually favors interest rate to hike by 1%, okay, by 1st of July. So March, there'll be a meeting. April, there'll be a meeting. And probably June or July, there'll be another meeting. So, 3 to 4 meetings, I would say, at most 4 meetings, okay, at least 3 meetings. Favoring 100 basis points would mean that at least a 0.25% hike in every meeting. And if there's only going to be like 3 meetings, all right, from now until 1st of July, then likely we're going to see a 0.5% hike in one of these 3 meetings, okay? So James Bullard actually favors a 1 percentage point of interest rate hike by 1st of July. And also, okay, bond unloading, okay, to start in 2nd quarter. He actually favors, the whole selling back of bonds into the market, okay, this whole process to start in the 2nd quarter, which is, well, pretty soon, I would say April, right? So he pretty much expects interest rate to hike in March, and then after which, once interest rate starts to hike, the unloading of bonds can actually begin. Okay, so all in all, 1, 2, 3, 4, 5 members of the FOMC have already spoken this week, and they've all been very hawkish. Okay, so that basically just adds on more upwards pressure to the US dollar, more strengthening of the US dollar. Okay, and something I want to share is this. Okay, when the inflation data was released, okay, we actually see a rise in bond yields as well. All right, so over here, okay, let me just just change the color and change the text a bit. So the blue line, okay, actually indicates the 10-year U. Okay, sorry, let me actually, you know what? Just double confirm that this is the one. All right. So the blue line over here. Just go to the chart. You forget about this. Okay, so basically what we are seeing right now here is the 10-year use, okay, 10-year US government bond use, the 5-year government bond use, and the 2-year government bond use, okay? So overall, we have seen a, let me just add, not this, okay, US05Y. Okay, and then we are going to add one more, which is the US02Y. All right. So over here, the blue line, okay, well, the lowest line, I would say, okay, the dark blue line indicates the US 10-year U, okay, and then the orange line is the US 5-year U, and the light blue line, so cyan line, okay, indicates the US 2-year U, okay. So overall, we see an increase in bond use, okay, which is I would say a common phenomenon. Okay, whenever we see more justification that the Fed will be more hawkish, okay, leaning towards interest rates hike, leaning towards monetary policy tightening. All right. So if we were to go to on the hourly time frame, oops, what happened to my? We can see that this horizontal, this vertical dotted line over here actually indicates the 9 p.m. GMT plus 8 to the 10 p.m. GMT plus 8 candle, okay? And about a period of time. And we actually see from there on, okay, there's actually a strong upwards move in terms of the 3 bond yields, okay? So that is the direct impact of bond yields whenever we see, or whenever we hear, you know, the Federal Reserve or the central bank themselves, okay, are more hawkish in terms of monetary policy tightening, okay, and of course, when inflation rise, you know, in this period of time, that further just strengthen the Federal Reserve's, intention of tightening policy, okay, and then let me go to another chart, which is the okay, this it's a bit messy over here, okay, because I have to place like all 3 lines together. Okay, so okay, I do not have the markings over here. So what we see over here are 3 lines. Okay, the blue line actually indicates the S&P 500. All right, S&P 500. The dark blue line. Okay, the dark blue line indicates the S&P 500, and then just this out of the way. And then for the orange line, okay, is the NASDAQ 100, all right? And then for the light blue line is actually the Dow Jones Industrial Average, okay? So what happens when the central bank, okay, is actually starting to, feel more confident in terms of rate hikes, in terms of monetary policy tightening, okay? Normally, we will see a weakening in the equities market, as shown over here. Okay, as usual, the vertical line indicates the 2100 GMT, the 9 to 10 p.m. GMT plus 8 period. All right, and then after to the right of this line, we see that the 3 major indices, okay, S&P 500, Dow Jones Industrial Average, and Nasdaq Composite, actually took a strong hit, falling down. Okay, so the common understanding is this, all right? Whenever interest rates will be hiking, okay, or maybe is expected to hike, all right, market participants tend to actually favors the cash assets more often than equities, okay, because it's more, I would say, it's more appealing, okay, because with an interest rate hike coming in and things like that, putting your money in cash assets, cash instruments, okay, will definitely result in a higher yield, okay, just as shown in this previous data, right? Previous chart over here, the major bond yields, government bond yields. Okay, so I mean, if bond yields are to rise like this kind of at this kind of level, at this kind of pace, okay, why not just put your money into bonds or into other cash instruments as well, as opposed to in equities. Okay, so as a result of the strong inflation data, all right, we actually see that the equities market, the US equities market took a strong hit. Okay, so this phenomenon can be expected across the other the other markets as well, like say the European market or the British market. Of course, it all depends on where the central bank stance is in terms of monetary policy tightening or loosening. Okay, so that is pretty much it for the US inflation data. Okay, so any questions over here? Okay, no questions on this inflation data. Okay, great. If you guys have any questions, just feel free to put it in the Ecofin chat platform. All right. Okay, so if there's no questions, I will hand it over to Scott for his analysis on DXY. Over to you, Scott.
All right, thanks for that, Gimme. And I'll just get into it now, guys. Definitely rewatch that segment as well, just from Gim Hong there. Definitely good points in regards to where the flows are going in response to the inflation increase that we saw last night. It's a bit of a confirmation that things were definitely not returning to a normal level according to the Fed's mandates as well. So we are seeing a little bit of US dollar strength here as well. I'll just go down to the 1 hour to see how we did see the reaction. So this is in GMT plus 8 time. We did see, this is why we do warn just to not go in with higher risk, because we saw the move higher, and then that was the hourly candle into the release, and then we saw it top out, and we actually did see 96 pretty much touch reject. We went down to 95.16 or so, where we've seen support previously, and now we did see that rally, and there was quite a lot of chop in the markets as well. But overall, with that bond yield comparison compared with the equity markets, that seems to be where people are positioning themselves. And as we get closer and closer to March with that deadline on the FOMC meeting and the rates decision, that's going to be key to see if really the anticipation of that brings upon more bond yield rising, and the US dollar as well. It seems to be contending with this 96 level too. So not a lot of news out for tonight. So it's just going to be a point of interest to see how the markets settle with this information, and whether or not we see equities lift a little, or if there is a further downside in the works here for equity markets. But 96 does seem to be a point of contention now with the buyers and the sellers. So I'll be looking out for that. If we do see a break, then that could really, and especially if that happens later in the session around when the US market opens, you more than likely you'll see a little bit of a pullback, but we could see some more upside here, most definitely on the US dollar, just with what we're seeing with bond yields. So be cautious if you are looking to take trades as well around this time, because markets just are a little unsteady, to be honest, and it's making it a little difficult. So be cautious there. So those are my thoughts on the US dollar. Now it is Friday, so we've got the CAD in focus as well. And we do have Jin back as well for that. So I will hand it over to you now, Jin.
Thanks for that, Scotty. So it's been quite interesting, right? We've seen since Monday all the way to Thursday evening, market has been sitting in that relatively tight consolidation. There are days where Kim Hong and I were just looking at it, and it's moved 20 pips at the most on top to bottom range. With the CPI number that got released, very good number, or very big number there. And as Kim Hong was just sharing with you, we're looking at possibly further or more consistent Fed actions in terms of increasing rates, which is why we saw that dollar strength come back into play, like Scott was just sharing with you. If it does break above 96, then, or it does test and break above 96, then we're possibly going to see quite a good upside to the US dollar. So what all this means is, looking at the charts here, well, first looking at the charts here, the US CAD, focus on the US CAD today. Last night, if I switch to the H1 time frame, we were just talking about this with the news release that if it did break below that 126.65 level, that was a very short-term trade towards the next support of 126.40. There was a good 20 pip move, almost instantaneous before it hit and bounced straight back up. That move was, a slight market reaction, and then after that we saw a slight market reaction. And after that we saw the US dollar strength come back into play, bouncing off that support, a very good support of 126.65, even breaking above 12712. This is quite a strong level. It was held since early Feb. We saw it reacting on the 7th of Feb and many times in early Feb all the way through to Jan as well. So coming back to the H4 time frame, what this means is we can see it broke above that 12712 level. Now it looks like what's going to happen, I'll zoom in again, sorry for moving the charts around so much. What looks like might happen is that we're going to see the US CAD retrace a little bit. It was a very big move we saw last night. We're going to see it retrace to test this 1.2712 level, similar to what happened in end of Jan, 28th of Jan. It shot up, it came back down before bouncing back up again. Similar to what happened at this point, it broke above, shot up there before coming back to this level. I think even if I zoomed out further, we can see this level, every time it breaks above, it comes back to test this 12712 level before retracing or bouncing back up towards that 1.2776 resistance level. So what I'm anticipating here at this point is for it to come back down, test that support level, which also gives you a good opportunity to jump into a trade if you have missed out on this move towards the upside. So a lot of patience required here. What you should be looking for is buying opportunities above 12720, above 12720. Because it's reacting to this support level, I would say you can keep your stop loss about quite tight, about 20 pips. You would have a good 50 pip take profit level towards that resistance level. I would say that this would be a trade that you can wait for. It needs to come down, test that support level before bouncing back up. If it does continue towards the upside, then you would be looking at a shorter term trade, an H1 kind of time frame for it to trade up towards the resistance. But I think in the medium term, look for it to test its support before bouncing back up. Some things to consider about when you're looking at the US CAD for this H4 trade is that into next week, because we're on Friday now, into next week, we do have the CAD CPI number to be released on the 16th of Feb, CAD CPI number month on month, and we also do have some US retail sales number that could also influence the US CAD towards the upside, or in terms of the speed of how quickly it's going to move towards that upside. So I think quite a simple trade, but it does require a little bit more patience for it to come down, test that support before bouncing back up. Short and sharp on the US CAD. I'll pass it back to you, Scotty, for crypto.
All right, thanks, Jen, and thanks for the question, Imran. And it looks like Gimme did take care of that. So thank you for that as well. If anyone's got any questions, feel free, but we will elaborate in the EcoFin Club as well. So we'll start with Bitcoin now. And we have seen, it's been interesting, just with everything that's gone on with the inflation news and whatnot and the uncertainties. It earlier on last week, it really did make a concerted effort to get itself back over 40,000. And now, really what I'd like to see is it to retest down here And then we'll see about potentially some continuation to the upside. But just with the situation still, frankly, with when the interest rates are going to go up and how much, really, I mean, the speculation is solid on March, but it just seems, even from a weekly standpoint, that it's tried its best here, Bitcoin. And we did see the lows tested of 33,000 earlier this year in later January. But let's just see how this weekly candle closes. And then I really do want to see some more downside and 40,000 tested. And then it might be 33 is the low, but we've still got a lot of time to go for the markets to really properly absorb an interest rate rise as well. So I'm just going to stay on the sidelines until then. This is more of a longer term entry on Bitcoin. So an ambitious one would be down below 30,000, but we'll see. That I would say that for a longer term buy, the value is not quite here yet. And it's just been a little choppy and actually has rallied, but I'm not a believer here that it's going to hold up and we're going to see more upside yet. So I'm just staying on the sidelines for now. Ethereum is a similar situation as well, just to bring up the weekly, and that's how it's looking. And if we can close around here where we are, then I would say it's unlikely to get through 33 or so, or 3,200, and that I would be well and truly more comfortable to take a buy as it gets lower, really back down to the 2000s or so. But that is ambitious, and it's going to take some time. So nothing really exciting to elaborate on here, and it's just a situation on the markets, it really transitioning into a more conservative cycle is what we'll probably see, just with everything that's happened in the past 2 years with all the stimulus. And I just think that there is going to be a little bit of a slowdown on people pouring money into crypto, and a correction is inbound. So those are my thoughts. Nothing immediate from a trade perspective, unfortunately, but updates will always be shared within the LCMS Traders Club. And thanks for the details there as well, Gimme, just on that question there, Imran. And I think that is it, guys. Thanks again for watching, and hope to see everyone next week as well for more currency calls. Bye for now, everyone. Have a great weekend too.